I expect the demand for both metals to continue. And I would imagine that over the next several years, silver will continue to make progress relative to gold because I think historically it's still underpriced. It's not as ridiculously cheap. We were over 100 to 1, earlier last year. And so you're never going to see, although never say never, I mean, probably not in my lifetime, but maybe in somebody's lifetime, maybe that'll happen again. But I don't think I'll ever see a situation where I can buy 100 ounces of silver for an ounce of gold. I think that's done.
They're really price insensitive when it comes to silver because it's such a small component of cost. So as we go into this situation of a rapidly rising silver price, and a lot of silver is starting to be taken off the market by now hoarders and investors. There's more buyers than sellers. Silver consumer saying, you know what, maybe there's a shortage, maybe there isn't, but I want to be sure. And they're rushing to market to get what they can just to be first in the queue.
In a recent discussion, renowned economist Peter Schiff and retired Swiss banker Clive Thompson analyzed the shifting dynamics of the precious metals market. Both experts anticipate sustained demand for metals, yet they project silver will significantly outpace gold in the coming years. Historically underpriced, silver's value relative to gold, which recently touched extreme disparities of over 100 to 1, is expected to correct, a unique market condition unlikely to be seen again in this lifetime. This momentum is driven by price-insensitive industrial reliance and a rapidly tightening supply as hoarders and investors drain available stock. With buyers now heavily outnumbering sellers, a rush to secure physical inventory is creating a palpable shortage, compelling investors to enter the market quickly to ensure they are first in the queue. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I'm not seeing volatility so much as just up and to the right. I mean, gold and silver just go up every day. There's some swings, but we're at all-time record highs. Gold is over 4,700 right now, 4,750, and silver was over 95 this morning. It's pulled back. Now it's back below 94, but, it just keeps making new record highs. Meanwhile, we're finally starting to see some solid strength in the mining stocks. Even though silver is backing off its highs, a lot of these stocks are now making new highs, which they should do because they're still ridiculously cheap. So there's just tremendous opportunity. I had, coming into 2024, I had about half of my portfolio in precious metals mining stocks. Now it's probably more like 70, 80% because those stocks have tripled and the rest of my portfolio hasn't gone up that much. It's gone up. All of my non-gold stocks have also done well, but not nearly as well as my gold and silver stocks. But, as big as 2025 was, 2026 is getting off to a much stronger start by far. I mean, we didn't even start moving last year until Q2. So as good as last year was, this year could be better, if you're invested in those stocks. I mean, for most Americans, I think this is going to be a disaster. 2026 is going to be a horrible year for U.S. financial assets, stocks, bonds, cryptocurrencies. I think they all get killed. I think that we're going to be moving up at a very sharp angle, whether it's parabolic or not. But I think there's, now a rush to get out of dollars and therefore into precious metals. And so you have a lot more people now that are waking up to what people like me were aware of for years. And so it's kind of been a slow migration for a small percentage of the population out of dollars into gold and silver. And as that was happening, the price gradually moved up from under 300 to 3,000, from 2001 to 2024. But the trajectory started to pick up in 2024 as the central banks got in on the action. And now in 2026, this is where I think the mainstream investors and the institutions are going to start participating. And so we're just going to have a lot more investor demand for precious metals, but not a lot of supply of precious metals to meet that demand. And of course, there's growing industrial demand too, especially for silver right now. So it's the perfect storm of exploding demand and, relatively stagnant supply. And in fact, as far as for industrial use, the supply is going to be going way down because investors are scooping up all the inventory. So if you actually need silver, you're going to have to pay up to get it. I think what silver and platinum have done is just catch up to gold, because gold really went from 2,000 to 4,000 with very little movement in those metals. And now all of a sudden, the markets are catching up to where they should have been all along. So I don't think that you're going to see a big reduction in the demand for gold. I think that's going to continue. I think that what you had prior to the last few months was the demand was concentrated in central bank. And so central banks just didn't buy silver. They just bought gold. But now that you have private investors getting in on precious metals, they buy both. And in fact, in many cases, they lean more towards silver than towards gold. So I expect the demand for both metals to continue. And I would imagine that over the next several years, silver will continue to make progress relative to gold, because I think historically it's still underpriced. It's not as ridiculously cheap. We were over 100 to 1, earlier last year. And so you're never going to see, although never say never, I mean, probably not in my lifetime, but maybe in somebody's lifetime, maybe that'll happen again. But I don't think I'll ever see a situation where I can buy 100 ounces of silver for an ounce of gold. I think that's done. And in fact, you think silver prices are high at $94. Pretty soon, you're going to look back at silver in a double digit at a cheap price, because silver is still under $100 an ounce. It's not going to be under 100 for long, and then once it really gets above 100, it's never going to go below it. It's just going to keep on rising.
In this insightful analysis, economist Peter Schiff discusses the explosive momentum of precious metals in early 2026. With gold exceeding $4,750 and silver hovering near $95, Schiff argues we are witnessing a massive wealth migration out of U.S. financial assets, which he predicts will crash, and into real money. He notes that while mining stocks have tripled, they remain cheap relative to their potential. The market driver is shifting from central banks to mainstream investors, who are now aggressively buying both metals. Schiff specifically highlights silver's potential to outperform gold, predicting it will soon permanently breach the $100 mark, leaving the historic 100-to-1 ratio behind forever as physical shortages force prices higher. Let's get into the interview.
It's not a new fundamentals. We've had the situation for about 4 or 5 years where the mined supply of silver, if we talk about silver here, has been less than the industrial demand for silver. So industrial demand is consumption by the electronics industry, by the solar panel industry, by the automotive industry, and so on. Of course, there's a little bit of that going into investment demand. Now, that gap between consumption and mine supply has been rising, mainly because the mine supply is it's not rising. It's fallen a little bit. I think it went up last year very slightly, but mine supply doesn't change very much from one year to the next for two reasons. First of all, most of the silver is a byproduct of other metals, and secondly, it takes perhaps 5 or 10 years to bring a silver mine on stream. So the mine production has been very, very static. Well, in fact, over the last decade, falling, whilst every year the demand for silver for industrial use, particularly electronics, has been rising and rising fairly constantly. So we reached the point a few years ago where there was a crossover. Demand exceeded supply, and the gap was met by what was, in fact, a huge quantity of above-ground silver. There's an awful lot of silver out there which has been waiting for donkey's years, for decades and decades, to get to its price. And as the price started to rise a little bit, a lot of it came on stream to fill the gap. But of course, as the price went higher, more and more sellers appeared, selling into that increased demand, and those who weren't selling were gradually becoming more and more reluctant to sell. In other words, they were the stick, what they call the damned hands, the ones who don't want to sell. So the first sellers are the paper hands, the weak holders. Gosh, it's gone up $5. I'm out of here. Whereas by the time it's up $20, the people who are sort of shrugging their shoulders say, "Well, I wasn't selling it was $5. I'm not selling it was $20." And they're getting stickier. So we're now in a situation where we can clearly see that it's getting harder for consumers of silver, the industrial consumers, to be sure that the silver will be there when they need it. I mean, don't forget, they're running production lines where silver is probably a very, very tiny component of their cost. But if they don't have it, the entire production line for vehicles or solar panels or electronics comes to a halt. They're really price insensitive when it comes to silver because it's such a small component of cost. So as we go into this situation of a rapidly rising silver price, and a lot of silver is starting to be taken off the market by now hoarders and investors. There's more buyers than sellers. So if you're an industrial consumer of silver, you need to be starting to worry whether you'll be able to get the silver when you need it. Will your production line come to a halt? So it's not a question of how much you pay for it. It's a question of whether you can get it. So I think we're part of the accelerated rise we're seeing now is every silver consumer saying, you know what, maybe there's a shortage, maybe there isn't, but I want to be sure, and they're rushing to market to get what they can just to be first in the queue. I think today when I looked, I haven't got it in front of me now, but when I looked earlier today, I think it was about $10 difference, which was close to the highest it's ever been. Now, the difference between the Shanghai price and the COMEX price, we're talking about the near-dated future price, is typically of the order of 50 cents to maybe $1.50 at the outside. And a few months ago, it started to widen. The gaps got wider and wider. And a few weeks ago, it was up to $5 or $6. We're all in amazement that this was widening up. And the reason which I saw at the time was that physical silver was not being shipped to China to close the gap, because it's perfectly obvious to me that if you are a large bullion bank and you've got some physical silver available, why would you leave it in New York when you could just ship it to Shanghai and it be there the next day, and you can collect an extra $5 on it, and then you can buy more in New York and keep doing it until the gap is closed. And that wasn't happening, and now the gap has widened, I think, to nearly $10, although it does fluctuate quite a bit, and that it does imply that even though ostensibly there's plenty of silver around, those who would be in the business of shipping it around to arbitrage it can't get it. The silver market relative to bonds or equities is absolutely tiny. So all it takes is minuscule changes in asset allocation by the big players, those who hold these trillions and trillions of dollars of bonds and those who hold the trillions and trillions of equities, to say, you know what, maybe we should have 0.5% in silver or 0.25% in silver. You know, if collectively they were all to decide that at the same time, you know, literally you'd just see an explosion way beyond what we've seen. Now that's not going to happen because these decisions take place very slowly, and for most big players, there's all sorts of implications if you suddenly change what you're doing, because you're talking about an asset allocation change. Don't forget, every large institution who moves money around will have legal departments who have to have their say. They'll have compliance departments who have to have their say. They'll have a safe custody department who decides who our custodians are going to be, where they are, and what form. They'll have a department which decides in what form we're going to take our asset. Will it be in paper form? Will it be in physical bars? Will it be which country? How are we going to do that? You're going to have a chief investment officer. You're going to have an investment committee. You're going to have boards of directors. There's a lot of things to be considered and discussed and argued before a firm can make a change in its asset allocation, especially if it's a new allocation of something they haven't touched before. So going from 0 to 0.25% silver might sound a nice, easy decision, but it's actually a very long-winded process and could take a long time. So it's not like everybody's going to decide on day one. They might all want to on day one, but they can't.
The structural deficit in the silver market has reached a critical tipping point. For years, stagnant mine supply has failed to keep pace with soaring industrial demand from the solar and electronics sectors, a gap previously masked by the liquidation of older stockpiles. However, those weak hands have exited mainly, leaving a market with dangerously scarce physical inventory. This shortage is now undeniable, evidenced by a record $10 price divergence between Shanghai and New York, an arbitrage opportunity that remains unclosed simply because banks cannot source enough physical metal to ship. While massive institutional capital is eyeing the sector, bureaucratic red tape slows their entry. When these funds finally navigate their compliance hurdles to allocate even a fraction of their portfolios to silver, the resulting demand shock against a depleted supply chain will be explosive. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.